Hey everybody, Marty Mazzara. Good evening. It's the 8th of May, 2025. This is your end of week update. Tomorrow's calendar pretty much requires that I get this out to you this evening, or that I record it this evening and then you get it in tomorrow's inbox, you clients and other subscribers. So today I am going to stick with the theme of discussing soft data. We will look at some valuation metrics, or I'll update you on valuation metrics for the S&P 500. We'll take a relatively quick look at the usual charts that we follow here on the videos, and anything else that comes to mind, but I won't keep you all day, I promise. So I think I want to start with this blurb from BCA yesterday, and that's why I say I want to stay on that soft data theme. So the title here of this little blurb is Inflation Focus Keeps the Fed Tight Despite Soft Data Collapse. And these are conversations that we've been having with clients during review meetings, and the questions about the economy and what the Fed will do and when they'll step in, they come up pretty regularly. And my narrative these days is somewhat of a, between a rock and a hard spot narrative for the Fed. So clearly you have the data beginning to wane. And again, per the title of this particular little blurb again, soft data collapse. Last week's end of week video I titled Soft Data. And soft data is essentially what the surveys are saying, right? What consumers and what businesses are responding in the surveys to about their state of current conditions and their expectations going forward. So what you typically see is the hard data, the actual numbers that come in, retail sales, housing starts, that sort of thing, waning in response to the fact that people are flat out telling the market that they're going to slow down, right? And so a couple points that I keep making. One that concerns me the most for equity investors is that the stock market just is completely complacent in that regard. That is just not remotely, in my view, discounting what happens to earnings during a recession. The conundrum, though, is, somewhat stubborn inflation. The Fed's tight policy stance, and that means they're just not even hinting that they're willing to cut interest rates at this point, and focus on hard data. And the hard data, again, has yet to roll over, reinforce BCA's U.S. bond strategist's call for above benchmark duration and Treasury curve steepeners. So that's what they call for. What they're saying is they're recommending people buy duration or buy longer-term Treasuries because they actually expect interest rates to fall. The steepening in the yield curve comes, and that is where you have short rates lower than long rates. And when you say steepening, what you might instinctively think is that the long end is actually going to go higher. Well, you wouldn't want to buy bonds. You'd want to be selling bonds if yields are going to go up. But there's also a steepening that is what's called a bull steepener, and that's where it's not about the long end going higher. It's about the short end going lower, right? The 2-year in particular, that will reflect where Fed funds rates are expected to go. So what this statement is suggesting right here is that the short rate is going to fall more rapidly than the long rate, but they're both going to come down, but you're going to end up with a somewhat steeper yield curve. And the fact that you're going to have longer rates lower, you get more oomph out of your investment the longer the duration of the bond. So if long rates go down, you're going to make money in the price of the bonds that you buy. And we do have a long-term ETF in our core allocation because we are essentially in that camp that says probabilities favor recession this year. But what's the conundrum for the Fed? The conundrum for the Fed is that inflation still remains relatively stubborn. Now, I'm going to show you today that yields spiked on what was viewed as good news around the trade front, particularly between the U.S. and the U.K. So if you're going to get more of that sort of good news, rates are reflecting an anticipation that maybe good news could avert a slowdown in the economy, and therefore rates are going up. If the Fed were to cut rates right now, like they did in the fall of last year and surprise the market, I think you would see instantly, if it were to happen today, longer rates, mortgage rates, for example, go straight up like they did last time, because the hard data is not yet reflecting a decline in the economy, something to pay very, very close attention to. They say right here, until hard data shows material labor market stress, the Fed's focus will stay on containing any sustained inflation risks from tariffs and so on. And to repeat what I keep saying, markets are not priced for recession, amplifying the case for defensive bond positioning and, I think, defensive stock market positioning as well. So speaking of stock market positioning, before we get to the technicals, I'm going to touch on valuations. So in front of you is the S&P 500 price to earnings ratio graph. The red shaded area in here is essentially what I've just picked as an area where valuations are so extreme that you should be cautious, that it's likely that valuations are going to have to come down off of these levels. Now, they could come down via earnings rising. So if earnings go up, all things equal, the price to earnings ratio goes down. But what I'm concerned about, obviously, is that it comes from earnings falling and obviously price following along with that. So we were sitting here in December of 2024 with ratios that were historically high. Came down with the correction, but they're back up in that red zone right here. And we're still in what we would call a high enough valuation setup, at least relative to PE, that says that there's not small risk that this could go down and test these lows and even go further down. Now, think about price to earnings ratio. It's very widely known that the PE ratio is probably the most manipulated or able to manipulate valuation metric out there. It's really how companies report and massage their earnings, right? They want to show good earnings. And the better the earnings relative to the price, the lower the price to earnings ratio. So we want to definitely look at other metrics and keep in mind also all the massive amount of share buybacks, over the years have served to depress that price to earnings ratio. Now, another metric that we want to look at that I think is more legitimate is price to sales. I mean, it's harder to manipulate the sales that come through the door, right? The receipts and so forth. So on a price to sales basis, you can see we are still way up there in the stratosphere, right? Right in here, after COVID, where, earnings were getting hit, but prices were higher because the powers that be threw $10 trillion into the economy and into markets. You can see even in the bubbly periods of the early 2000s, late 90s, you weren't where you are even currently. So on a more legitimate price to sales ratio, which is also affected by share buybacks, by the way, you're still historically expensive. Price to book value, historically expensive. Apparently in a 2001 interview, Warren Buffett told the interviewer that the best valuation metric to look at is the stock market relative to the size of the economy. And the stock market in this case being the Wilshire 5000, which captures virtually the whole gamut, versus GDP. You can see that we came into the year at an all-time high of 200%, and we're still sitting here very, very lofty at 188% market cap to GDP. Even the historically expensive, early 2000s was not close to what we're looking at right here. Another way to look at it from BuffettIndicator.net. And again, that particular metric says stocks are significantly overvalued right here. Robert Shiller, Nobel Prize winner for this, the Shiller cyclically adjusted price to earnings ratio. It's considered by many a truly more legitimate way to value the market, and it takes into account past cyclical dynamics. And you can see it is historically high. Here is the tech bubble in 1999, and then here we are now. So not that high, but still relative to 140 years of history. Right now it's higher than it was during 1929, right before the great market crash and the Great Depression. Okay, so what's my point? Valuations are still troubling us right here, folks, and I promise you, we will all live long enough to hear me get resoundingly bullish, but just make no mistake, historically speaking, bull markets, new sustainable bull markets, never start from these levels, right? They start from these levels. Or I could say bear markets do not end with these level of PE. Okay, so let's just finish up quickly. The price charts, we'll just focus on those. I said the other day that, that 200-day moving average is where bear market rallies go to die. This right here tells you that at one point here today, the S&P was way up here, but it closed right here, just a little bit higher than where it opened, but it had a very wide range. And you can see that as it approached the 200-day moving average, the traders began to sell. Still just slightly above the 62% retracement of the big decline, and we've talked about how important these Fibonacci retracements are technically. As for the NASDAQ 100, or the ETF that tracks it, as you can see, it did peek its head above the 200-day moving average and then promptly sold off of that, sitting virtually right on that 62.8% retracement. It's going to be very interesting. You would, right now, I would say odds favor that it fails right there, but today we had a good positive tweet, so to speak, or comment from Washington about a trade deal with the UK, and we got this big spike, but we did sell off of that. It was interesting that UK stocks traded in America were actually down on the day. We'll probably get into more details on that trade agreement as they surface. Yields today, as I said earlier, did jump pretty notably. That ETF that I talked about that we have actually went down today in price. I say notably for one day. And again, rates going up on the potential for, recession-resistant news, right? So that, hence my point, that if we start throwing a lot of stimulus in here too early, you're going to get higher rates, and that by itself is problematic for things like equities. The dollar also rose with interest rates today, and on that optimism, you can see it's bumping right up again this very well-defined downtrend line. We'll see how that plays out, but it looks to me here like the dollar has been wanting to go a bit higher, and consequently, I might say that was a problem for gold today, right? We looked at this here a couple days ago, and I said this looks like kind of a classic double top to me, particularly because we have these very clear bearish divergences on momentum. And I think gold closed down about 2% today. We definitely felt it in our core, but we are hedging it, so we're mitigating a good chunk of that decline. So up here with these technicals, we're still going to be hedging that not small position for us. Oh, and then another thing I wanted to show you here. This is a chart I put together years ago, and it's been interesting. Very, very slow moving. So these are ones that I'm not going to show you every day because it takes a while for these moving averages to change. So what I've got here is the 20-week moving average, 30, 40, 50, and 60-week moving average. So when the orange is on top, the shortest term, that shows you that there's momentum in the market, and it's very positive momentum. When it begins to roll over, and these are slower moving, again, the fastest is the 20-week moving average here. You start realizing that, things are really breaking down in terms of longer-term momentum, right? Layered on here is the PWA index, which we invented back in here in 2017 and then back tested. And I just picked spots in here. Obviously, it's a weekly scored index, so there'd be zillions of numbers in here. But I just picked spots that looked like they were at key levels. So here we were in 2015-16 on a back test with this indicator rolling over. So the technicals were looking concerning, but the PWA index was actually nicely positive still at a plus 18. Here in 2018, when we got that big decline, a 20% decline, there was nothing fundamentally that had us nervous, so we rode right through that and did really, really well. On the contrary, up here at all-time highs in August of 2019, our index rolled over. We started hedging our portfolios, and consequently, we only suffered, in most cases, a mid to high single-digit decline when the stock market went down 35 to 40%, depending on the index you're looking at. Then you can see the index got positive right in here. We had a nice run. It got negative here right as the market was rolling over for that 27% decline. We were expecting a recession, and we didn't get it. In fact, the 2023 was one where virtually all economists, one exception who I pay for his research and I respect him a lot, who's notable to me, was saying that we all got it wrong and there wasn't going to be a recession. Well, nevertheless, stocks went down almost 30%. Then we came back out of it, and we had several weeks in here where our index actually turned green, which, by the way, is 43 economic data points across, everything from, consumer activity, retail sales, housing, to inflation numbers, to business activity and CapEx spending and yada yada. But so it's been a pretty decent tool for us, I should say. So here we were, and now here we are rolling over, and the index, as of the latest score, is a negative 16.28. So, folks, this demands that we have some protection in our portfolio. And you can see how it was back in here during the somewhat corrective period in the mid-90s. We were up 25. In here in 1998, which was a scary time, I lived at Long-Term Capital Management, the largest hedge fund at the time, went out of business. Russia defaulted on its sovereign debt. Swift's 20% decline, but we weren't scoring formally an index, but we were doing a lot of economic work back here. And we held our ground until finally, you can see it all rolled over during the tech bubble. And here we were, in 2008, doing fine, and then fundamentals rolled over and the market rolled over hard right at the same time. We held our ground all through here very profitably. And then right in here is this whole period right here, we've had some defense in the portfolio that has been golden when things have come down. Obviously, when things are roaring, we're always wishing we had more exposure to it. But until our macro and technical work says that the coast is clear, which it will ultimately, I suspect, from lower levels, we'll continue to have some defense in our portfolio. I can end on this one. This is just volume. So many things that we track, and we have a day like today, which for the most part during the day was a pretty good up day. Volume really just was kind of blah, right? So it ended the day at 5% below its 20-day moving average for the S&P 500. And you can see sector by sector. Information technology, which had a really good day, was trading at volume at 14% below average. Consumer discretionary, 13% below average. Financials, 10% below average. Industrials, pretty average. Staples, 5%. Materials, 26% below average, right? And but then you had communication services, which had pretty good volume. Healthcare had pretty decent volume, although healthcare was down on the day pretty notably. And then energy had pretty good volume, and it was up. So why is volume important to us? It's a view of conviction. When you have a day of blah volume and the market's up a bunch, that tells you that it wasn't a big mass, rush to buy. There was a few buyers, and there was just stubborn sellers. So that means that the markets got bid higher because whatever buyers were there who really wanted to transact had to do that at a notably higher level because the sellers just weren't ready to sell the level that the buyers perhaps started bidding at. So the market got bid higher. And it's going to show you, if one share trades hands and that's it, it's going to show you that price, and that was the movement of that particular share. So we got to look a little further below the surface, and we look at momentum and things like that as well. But volume is pretty telling. And so today tells us there was nothing all that special. There was a big spike early on, and then that news was good, and it didn't inspire anybody to sell, but it didn't really inspire people to come rushing to the market. So, folks, thank you again. I seem to be rambling more these days, so these are going a little longer. Appreciate you for hanging in there with me. I'll throw something at you over the weekend if I think I need to when we go through our macro work, but could be that this is it for the end of this week, and if so, I'll be back at you midweek next week. Have a wonderful weekend. Thanks again.